Is your business protected against the threat of malicious litigation and frivolous lawsuits? Are you sinking company profits into marketing campaigns that do nothing to contribute to the growth of your business? Bottled Business Sense provides practical business perspectives that uniquely emphasize both legal and media marketing strategies to protect and ensure the longevity of your business. Now, whether you're trying to provide a startup business with some level of stability or an established business with foolproof asset and estate protection, or simply attempting to get a better return for your business marketing dollars, Bill Bernard and Rick Moscoso will expose potential pitfalls to ensure the security and growth of your business, free from unwanted expense and the threat of litigation. You'll learn how to implement marketing and protection tools equal to those used by today's most successful corporations. Let's join Bill and Rick for today's Bottled Business Sense Show.
Good morning, everyone. This is Rick Moscoso with the Bottled Business Sense Show. Today is Tuesday at 10 a.m. and I want to welcome all of our returning viewers as well as our new viewers out there. Before we introduce Bill, I just wanted to share with you the purpose of the Bottled Business Sense Show is to help our entrepreneur business owners out there, and with business tips, legal tips, marketing tips to help you run your business efficiently and profitably, and also be protected from a legal standpoint. And we have a whole host of previous episodes in regards to these different topics. You can always go to our website and look at our archives at bottledbusinesssenseshow.com and take a look at the categories, and you feel free to peruse our extensive library to any subject matter that may be applicable to your business. So we also welcome any feedback, any topics that you would love to hear on the show, as Bill, myself, and our coaching specialist, business coaching specialist, Steve Smith, we discuss on a week-to-week basis. So please send in your feedback at bottledbusinesssenseshow@gmail.com. And if you'd like to be a guest on the show as well, please reach out and send us some information in regards to maybe some subject matter that you would like to discuss here on the show. We're also on social media, on Facebook, Twitter, LinkedIn, Google+, with the Bottled Business Sense Show handle. So with that, I want to welcome my co-host and legal expert, Mr. Bill Bernard. How are you doing today, Bill?
Doing great, Rick. Thank you. I want to pick up on a couple of things you said. You mentioned that we're here for our business owners, entrepreneurs, small business owners, large business owners, etc. And, we often overlook sometimes the fact that from these businesses, once they're protected and prosperous, we have proceeds from that business. We have income from that business. We have money that then becomes taxable money. We want to find a way to help protect that money as well. So I thought we'd do a little bit of an estate issue today and talk about some of the ways to ensure that some of your hard-earned dollars are protected once you receive them as income or as a distribution, should you have a business entity of some sort. And I will admit from the outset that this is geared to a little bit more toward larger estates, people that have become very profitable, very successful. It's not to say that these policies can't be implemented by the average guy, but as the more successful you become, the more tips we try to provide in how to protect your money. And this is going to be devoted today. This show today is going to talk about what's typically referred to as an ILIT. It's ILIT, and it's an abbreviation for what is typically referred to as an irrevocable life insurance trust. And the reason we bring this up is many people, many listeners, many business people have life insurance policies, and they tend to many times to take out life insurance policies on themselves. And sometimes we forget that life insurance proceeds are typically not taxable income. But if you're not careful about the ownership of the policy, the proceeds are subject to what is called the estate tax or the death tax, which means that 40 cents out of every dollar might be lost as taxable income. Here's what I mean. When you pass away, your estate is taxable up to what the maximum is currently, and it could change from year to year depending on what Congress does. But right now, it's roughly $5.43 million. So if your estate is worth more than that, and, you know, with long-term pension programs and with the retirement programs that people are looking to, it's not so much out of the ordinary nowadays that when somebody retires, they have an estate that's worth $5 million or more. So if you have an estate that's worth over $5.43 million, you're going to be taxed on that income. If your estate is less than that, you won't suffer the estate tax, and your beneficiaries will be able to receive the full force of your assets at the time you pass.
Yeah. So Bill, I've got a quick question. Sorry to interrupt. Just trying to understand and maybe dumb this down a little bit for some of our viewers like myself. How is this different? How is the ILIT different from a normal irrevocable trust?
Well, that's a complicated question, Rick, that probably is best left to a different show. I'll tell you in a nutshell that there are many different types of irrevocable trusts. This particular ILIT is an irrevocable trust that's set up to allow insurance proceeds to benefit your beneficiaries as opposed to you, and it's set up to make sure that your estate is not taxed at the time of your death because the insurance proceeds are not then part of your taxable income. Other irrevocable trusts can be set up for a number of different reasons. But what we're focused on here today is the problem that we have in taking out insurance policies where we're the owner of the policy, and many people think that's an apropos way to go. Well, it depends on what your outcome is. What do you want your goal to be? If your goal is, to example, to make sure that your children who are minors have proceeds to go to college with, for example, at the time you pass, then a great way to do that is to set up an ILIT and leave the insurance proceeds at the time of your death to this trust. Okay? Instead of leaving it to someone else like your spouse, because many times the IRS will take income that goes to your spouse to be income that belongs to your estate jointly, and that will allow it to be taxed. So here's the dilemma. If you have an estate that's worth under $5.43 million currently, and you pass, you're not going to suffer an estate tax. But if you're teetering on that amount, any amount over that will be taxed at the time of your death. And if you have a life insurance policy that pays out to your spouse, for example, that's going to put it over. If that puts it over the 5.43 million, then you're going to be taxed on that amount. So what we want to do is leave that insurance proceed to the trust, make the trust the beneficiary instead of your spouse. And that allows the income to go to your beneficiaries, which would be your children, so they could then use that income for college, and you're not taxed on that income at the time of your death. Your estate isn't, because the trust owns the insurance proceeds as opposed to the insurance proceeds being owned by somebody like your spouse. If the owner of a policy and the insured person under the policy are the same person, then it's taxable, okay? Or if it's over 5.43 million. So you take out an insurance policy on your life and the proceeds are payable, the proceeds are payable to you upon your death. They go naturally to your next of kin, right? Which is going to probably be your spouse or somebody else. That insurance policy is taken out and paid out to you and your beneficiaries directly. You want to have it paid out to the trust, make the trust a beneficiary. That trust then can disperse the money to your children at the time they reach the age of majority or whatever time they go to college as set forth in the terms of your trust. So let me give you an example. Suppose I buy a $1 million life insurance policy on myself to make sure my kids have money for college. If I die while they're young, So if I die while they're young, they can go to college. That's what I meant. If I buy the policy myself and the proceeds are at risk because I'll own a policy that insures my life, the $1 million in proceeds will be part of my taxable estate if the value of the estate in total is over 5.43 million. Okay? But instead of buying the policy myself, I create an irrevocable trust that will buy the policy. The trust buys the policy. When the proceeds get paid out, the insurance proceeds won't be part of my estate because I made sure that I wasn't the owner of the policy. So when the proceeds are paid to the trust will have instructions in it to pay out payments to my kids for the time at which they go to college, to pay for their college education or to pay for some other life event that you need to pay for. So there are requirements to do this properly, and that's what we're going to talk about next. But I want to make sure that both you and everyone else out there who may be listening or watching has the basics down pat right now.
Okay.
So that's kind of what the idea is. And when you asked before, how does this differ from other irrevocable trusts? Well, this irrevocable trust differs because it's set up specifically to deal with insurance proceeds and to provide for your children or somebody else in terms of a specific goal that you want to have accomplished for somebody that's near and dear to you after you pass. Okay. You may not have a need, Rick, for an irrevocable trust for any other reason. Those are things you need to discuss with an estate planner. Do you need an irrevocable trust for other issues? Maybe so. But right now we're talking about life insurance.
Well, I knew in asking the question that you could, in your simplistic explanation, make it even understandable for me. So thank you for that.
Well, no, listen, it's a complicated area. I recommend people seeing an estate planning attorney when they do this stuff, obviously. But this whole principle, when you boil it right down, is pretty idea specific. It's pretty goal oriented. So let me tell the viewers out there some of the requirements that they're going to need to handle. First, you got to designate somebody to manage the trust, the irrevocable trust, which we're going to call a trustee, right? You cannot be the trustee. You cannot be the trustee. If you are, the tax laws will treat the proceeds as part of your estate, even if you claim the trust has bought the policy. You can't be the trustee because now you're intermeddling, you're interfering with the operation of that irrevocable trust. That irrevocable trust is supposed to stand alone, separate and apart from you. And if you have control...
So you're saying that you could not have then a revocable life insurance trust, right?
That's absolutely correct. Yeah, because the revocable trust is yours. You can't do it. It's got to be irrevocable. And it's got to be, because remember, when you're talking about an irrevocable trust, you're talking about separate and distinct ownership. The trust owns whatever you put in that trust. You no longer own it.
Right.
So, your spouse should not be the trustee, as I mentioned before, because the IRS looks at spouses as one unit. And if your spouse owns the policy instead of the trustee of the trust, it's the same as if you own the policy. Your kids are too young to be the trustee, right? And even if they were old enough to have a job, the rules specifically say that you effectively control the policy because the kids are very likely to follow your instructions if they're minors. So they can't be the trustee.
What if they're not a minor? What if they are an adult? Could they be assigned as the trustee?
Well, but you're setting it up for their benefit.
Okay.
So you typically, if to make it clean, you want to make sure that the beneficiaries and the trustee are separate and distinct parties. That would be the cleanest way to do it. So what this means is you need to have someone else who's independent of those parties to be the trustee of your ILIT. And that could be siblings, brothers or sisters, close friends, trusted advisors, Bill Bernard, Rick Moscoso. We're always willing to help out, right, Rick, if we have to. So that's the first thing that we need to remember. The second thing we need to remember is if you pay a premium on the policy from your own funds The laws treat the proceeds as yours despite the trust. So the proceeds can't be paid out of your own funds. The most common solution is to make gifts to the trust and let the trustee use those funds to pay for the premium. So here's what I mean. You're allowed $14,000 a year to make as a gift without having to file a gift tax return. If you make a gift to somebody each year and it's over $14,000, you have to file a gift tax return. But if you gift $14,000 or under per year to someone, and in this case, it could be the trust, then those proceeds are not yours anymore. They're a gift to the trust. They belong to the trust. They're non-taxable as gifts, and the trust can then use those proceeds to pay for the premiums of the trust. So whatever you anticipate the premiums being that year, you can make non-taxable gifts to the trust. The trust now owns those proceeds. The trust, and not you, can make payments on the policy that's owned by the trust.
So you're saying if this ILIT is for me and I want to gift the ILIT, I can just cut a check for the maximum allowable of, let's say it's for, like in your example, 14,000, and we're good.
Yeah, let's say the premiums. I'll just pull a number out of the year. Let's say the premiums every year for the policy is I don't know, $500. So you pull out 14,000, you give it to the trust as a gift. That's non-taxable. You don't have to file a gift tax return, and that 14,000 can cover however many years of payments. 500 goes into 14,000. Or you could do it a different way. Just gift the amount of the premium, or a couple of years premium, or anything. You can gift any amount as long as it's 14,000 or below. Now, to make this work, we need a third requirement, and that is you need to give the money to the trustee, and then the beneficiaries of the trust must have the ability to withdraw the money. It does no good if you give this and set it away for the trustee, and then he's got total discretion. You have to have in the trust the terms that state that the trustee, that the beneficiaries, your children, will at such and such a date have the ability to withdraw this money to use for whatever purpose you set out the money to be used for. In this case, we're talking about college. So those are the three major requirements, and it's not as tricky as it sounds, other than having to pay for the cost of the policy by depositing gifts into the irrevocable trust, and also setting up the irrevocable trust is going to cost some money. But if you've got an estate that's bordering on $5 million, and you want to set this up for your kids and you want to avoid taxes, again, this is all based on the premise that you are an unselfish person. You are wanting to plan for your family's future. You have a successful business, perhaps, that is making a lot of money, that has been consistent throughout a number of years. It's well protected. You don't have to worry about the business assets. You don't have to worry about your personal assets. You have liability insurance. You have the business entity set up. Now, the last step is to protect the family. How do you protect the family for needs that they may have? Well, one of the ways to do that is to set up an ILIT, an irrevocable life insurance trust, so that all of those things are taken care of and your estate won't be taxed on it once you pass. That's really how this whole domino thing plays out. And that's why I included it in our show, because even though it doesn't have directly to do with your business per se, it certainly has an effect on the money that your business makes and where you want it to go once you pass. This isn't a continuing process, in my view, Rick. That's why I've always said business lawyers really need to be familiar with estate planning, asset protection, and employment law, because all three are so much interconnected to a business. If you're a business attorney dealing with businesses, you need to know how to set up a business entity for the business. You need to deal with employee issues for businesses that hire employees. And you need to be able to take what the result of that business is, the money the business makes, and have that protected from excessive taxes once you pass, so your family can enjoy the fruits of your labor, right? I mean, after all, it all goes hand in hand. So remember, an ILIT requires annual attention. Records must be kept to document all withdrawal rights, actions by the trustee should be reduced to writing and kept for the term of the trust. And if you start giving money that exceeds the $14,000 per year gift exclusion, then you're running into trouble, and you might need to see an accountant or a tax attorney to figure out what your gift tax is going to be. Because you can certainly gift money to that trust that owns the ILIT in excess of $14,000, but if it's in excess of the exclusion of $14,000, now you're talking about a gift tax. Remember, a gift tax is different than an estate tax. An estate tax, otherwise known as the death tax, is taxed on your estate at the time you pass based on the value of your estate. If it's over $5.43 million, the gift tax, you're taxed on any gifts you make that are over $14,000 per year. You make them 14 or below, you don't have to worry about any gift tax.
Awesome.
So that's kind of where this is all going, Rick. And so the real moral of the story here is don't take out a life insurance policy on yourself if you don't have to. Set up the trust and avoid these pitfalls. If you have a very modest estate, you may want to wait till later on to do this until your estate grows bigger. But I remember when I started out in practice 30 years ago, the goal was to have $1 million to retire on. That was the legitimate, realistic goal somebody was looking forward to be able to enjoy a secure retirement. Today, it's much closer to the $5 million. So it's not unusual for people to have plans that say, well, at the end of my 30 or 40 years of working, when I retire, I'm going to have a $5 million estate or more to retire on. And if that's the case, these ILITs all of a sudden come to the forefront much more so than they did many years ago.
Yeah. Yeah, I remember that back when I was working in corporate, that seemed to be the magic number, and certainly it isn't anymore. That's for sure.
No. So, I hope our viewers and listeners got something from this. It's always nice to be able to go back and listen to this program, do a recap on it, find out if it fits your situation. But so many of these terms I find on the internet are just posted and people are expected to know the answer to it. Well, I guess you could say because of Google and other search engines today, it's easy to maybe do a little bit of research on your own. If you have the initiative. But I think that to put maybe a lawyer's twist on it or to emphasize some of these things to where you can sit back, put the earphones on and listen to it provides a little bit more leisure to the time you might have to devote to other things. You can listen to this in the car, for example, while you're traveling or doing something else. And I'll let you speak to that. I know we've talked about this briefly, Rick. And do our viewers and listeners have the ability to download these programs?
They do yes, they do as a podcast, whether it's a video podcast or audio podcast. They have the option to do both. Just go to the website, and depending upon which version that you're looking at or viewing, you do have the ability to sync that up so you can listen to it on the car as a podcast.
Okay, fantastic. Well, there you go. So Rick's our expert in that area, and we hope you've gotten some benefit from this. Again, it's not an everyday topic, but ILITs are becoming more and more popular for the reasons that I discussed. And if this is something that's right for you, please feel free to call me or another estate attorney who's qualified to speak to these issues, and we'll be happy to help you.
Yeah, no, this has been a great episode today, and like I've said in the past, we learn every episode when Bill speaks to business issues, legal business issues, or trust or estate planning items such as this, and certainly reach out to Bill. He has a way of really simplifying the explanation so you understand clearly what all your options are, and you can make an informed decision one way or the other, and Bill's just a master of doing that. So reach out to Bill if you have some more questions regarding the ILIT or any other business related legal topic. His contact information is below this video, or certainly reach out to him. Bill, what's the best phone number to get a hold of you?
Two phone numbers, both 949 area code. The first is 413-6535, and that's my direct cell. I give that out willingly so people can contact me directly. The only time I won't answer is if I'm in a meeting or in court or doing something with another client, but I'll certainly get back to you. The other is a business line that can be reached, and that is 698-6222. And, of course, you can go to wfblegalconsulting.com as well as bill@wfblegalconsulting.com as my email. I should take this time to mention that Rick is working on a new site for me that will be devoted entirely to estate planning. There's a lot of estate planning information on my main site, wfblegalconsulting.com, but there will be a new site that is up now, but it'll be revamped and revised to help people actually create and design their own estate plan with my assistance and allow their input to be recognized directly. And it really gives you a lot of satisfaction to participate in that way. And that's going to be protectyourestate365.com. So we'll let you know when that's up and running.
Yeah, I'm excited to work on that with Bill because, we're taking advantage of his insight and his ability to inform and educate any prospective client. And so there will be short form videos on here that will certainly do that. And I'm really looking forward to start working on that with Bill and sharing it with our viewership. So, yeah,
and I can't emphasize enough to watch those videos, if for no other reason, to get an idea of Rick's expertise. You'll be able to really see what good quality videos are, and believe me, he can do that for you too. So take an opportunity not only to learn about estate planning, but to be able to see firsthand what these videos are, how powerful they are, and how they can really market your business to the maximum extent. So with that, we'll say goodbye till next week. I'll look forward to seeing you at the same place, same time. And I hope you have a prosperous week, and that all your dreams come true this week, going forward, because that's what we're here for, right, Rick?
That's right. Well, we'll see everyone again next week at 10 a.m. right here on the Bottled Business Sense Show. All right. Take care.
Take care, everybody.